All right, everybody, Mike Lieberman and Dr. Charles Lieberman, Chief Investment Officer, Advisors, Capital Management, 10-second interview show. Chuck, great to see you again. Before we get into it, I want to tell you that on LinkedIn, we were referred to as the hashtag not so 10-second show. And so, people are saying, like, maybe our answers are getting a little long-winded, a little long in the tooth. Hollywood writers, they're coming off strike. People are going to be coming for us. People are going to be coming for our show. So we got to bring it into 10 seconds. TikTok dudes, TikTok world. Let's get into it fairly quickly. 5 questions, 10 seconds to answer each one. Markets are chopping around like crazy, right? Higher for longer. The Fed has come around to that. 10 seconds or less, Chuck. How much higher? Interest rates.
Oh, I think we can get up to 5% on the 10-year. But I think we've run the course for the most part. Rates are now attractive enough relative to inflation to induce buyers to come in.
Okay, good. Higher for longer. How much longer do interest rates stay higher?
I think quite a bit longer. Certainly the first half of 24 and probably even the second half of 24. Inflation will take a while to come down. And until it does, it's premature for the Fed to lower rates.
Okay, so market has come around to that and is gotten volatile, has gotten choppy. Certain sectors, having a tough go. Utilities in particular, right? Debt-heavy, assets. They can't really raise the dividend. They're not really growing, all that much. So why take the risk in an equity yielding 4 without growth potential when you can go get 5 in a treasury?
Well, if you're in equities, the economy is continuing to grow. Corporate profits are going to be reported for the third quarter next week. Those estimates are revising higher. Same for 24. If the economy's not going into recession, equities are going to do better on that basis. And even on the fixed income side, or for income-oriented investors, there are a lot of equities that yield a lot, and they don't need a lot of growth.
And that was definitely more than 10 seconds. So
yeah.
It wasn't even close. Okay, so what about the consumer, right? Higher inflation for longer, this has got to hurt people who are maxing out credit cards, who are paycheck to paycheck. Does that show up in the economy? Does that create any sort of slowdown type of environment?
Theoretically, yes, but people are not in that predicament. If you look at debt, it's low. If you look at income growth, it's strong. Wages are rising. Hiring is continuing. The consumer is not in trouble.
Okay. Last question. If I can get 5 from bonds, right? Treasuries, safe stuff, short treasuries, 5.5. What number gets me or an investor to invest in stocks? If you told me I could get a 6% annual return and deal with the volatility of stocks, or 5% in treasuries, I'm probably taking the 5. If I could take, is it 7? Is it 8? Where's the number that an investor needs to be enticed to own equities over stable value bonds?
So the question is, what is the equity risk premium? And I would say it's in the ballpark of 3 to 4. And I think you'll get that from growth in the economy and growth in corporate profits. So I think stocks are very competitive with bonds. Bonds have gotten finally competitive with money markets. So I think there's value in the market now.
Okay, so you're saying a 9% return on equities is what you would want in order to offset the lack of risk from fixed income. Okay, so that's it. 5 questions, 10 seconds or less. Well done, Chuck. 4 out of 5, 80%, Hall of Fame material. We will have more updates for you as markets continue to do what they do. Thanks, everybody. Oh, by the way, like and subscribe. I am told that is the magic phrase. Like and subscribe below. More subscribers, more content. Hollywood writers won't come take our jobs. Thanks, everybody.